One of the most important things in trading to understand that no one seems to talk about is drawdowns. And they're so important that until I went through and withstood my first drawdown, I didn't have 100% trust in my trading system. So had I not known how to get through that, I probably wouldn't be here today. So in this video, I'm going to cover everything from what drawdowns are, when you should expect them, what you can do about them, and how they can help you grow and become better as a trader. All right, so first things first, a drawdown is the natural decline in your trading balance between equity highs. Basically, from when you last had the highest balance in your account to when you get the new high balance in your account. Now, most traders, particularly new traders, they don't expect drawdowns, particularly prolonged periods of drawdown, and they've got unrealistic expectations about how frequently a trader is in drawdown in the first place. Now, some weeks, like this week, I've had 3 for 3 trades and I'm up, and I'm not in a drawdown. I've had a really profitable week, but most of the time it isn't like that. Just consider this for a sec. Let's just say that you have this winning week, right? And you have a tremendous week, and then you sort of go sideways for a bit, and then you have another winning great week, and there are a couple of trades that put you ahead, and then you have a bit of a decline, bit of a drawdown, you move sideways, and you have another winning week. And ideally, your equity curve will look like this, right? It will start to grow. But consider this. Here and here is where you weren't in a drawdown. Here and here is where you weren't in a drawdown. So same as here and same as here. But most of the time, the majority of the time, if your equity curve looks like this, you are going to be in a drawdown most of the time. And when you get your head around that and you understand that your equity curve probably isn't just going to look like this, and if it does, let me know and I'll give you all my money. Just kidding. But you can set some realistic expectations once you can accept that most of the time as a trader is spent in a drawdown. So a common misconception is that trading's always about winning, but it isn't. Losses are inevitable. Now, the problem is no one talks about this because most marketers or gurus and all those kind of scams out there, they're not going to talk about drawdowns. They're not going to talk about losing periods because that doesn't sell. It's not sexy and no one's going to want to buy that, right? But the reality is you're going to have drawdowns. Now, I want you to think about it this way. There's always a cost of doing business. Trading is a business, and drawdowns are a part of the cost of doing business. So check this out. In a conventional business, let's just say you sell widgets, right? And the widget, the total cost of producing that widget, which is your overheads, okay? And the total price, the unit price that you're going to sell that widget at, which is your RRP, say, right? And guess what? Once you make that sale and you pay the overheads, you get something called profit, right? And that's whatever is left. And if you're in a bricks and mortar business or you're in a retail business, it might be something like 30% or something like that, but the profit. And the reason that's not hard for you to understand is because the overheads, the cost of the packaging, the cost of the suppliers and the delivery charges and the postage and whatever, right? All of the bits and pieces, the shop rent, all that kind of stuff, what it costs to produce one unit and sell that unit to make a profit. And the difference between this and trading is in this, it's a unit by unit basis. So if you sell 10 of these, the profit's linear, right? If you sell 50 of these, that you get paid and you get that much profit on each unit. In trading, it's not quite the same. So think about trading. This is your end of year or end of month or end of quarter, right? And you're going to have overheads. And the overheads might be broker fees, and they might be internet connection and losing trades, drawdowns, right? Losing trades, losses. You have to take some losses. So if all of your trading activity is this, then this is your losses, this is your overheads, and this is your profit, right? Now the difference is that doesn't come on a unit by unit basis. You might have 3 winners in a row, then 5 losers, then 10 winners and 1 loser, then 7 losers, then 1 winner. So it's sporadic, which is why it's important as a trader to focus on profit over a long period of time. So how you manage the drawdowns is what's going to determine whether you're a good trader or a bad trader. The best traders are systematic, and they don't get too emotional or excited during winning streaks, and they don't get too emotional or depressed during losing streaks, because they know that overconfidence during a winning streak is just as dangerous as fear during a loss. It's either going to cause you to overtrade or revenge trade. So this is going to be a bit of a kick in the teeth for some of you watching this, but if you're asking the question, when do I know if I'm in a drawdown, you shouldn't be trading yet. You're not in a position to be trading. And the reason for that is because professional traders are prepared for drawdowns because they understand the historical behavior of the market, and they know the probabilities, and they rely on those probabilities, not their emotions. And talking about historical data, there's something called a normal drawdown, which is what I'm explaining right now, and there's an abnormal drawdown. And the abnormal drawdown, it's crucial to understand when you're in an abnormal drawdown, and you know when you're in an abnormal drawdown because of historical data. The beautiful thing about being able to test these markets is that you have confidence in what has happened in the past. And once you understand what's happened in the past, guess what you can do? You can compare that with what's happening right now. And if you're taking the averages of the last 10 years, well, guess what? If you're outside that average, maybe there's something not quite right. But you won't know that until you've tested that data. So backtesting provides a baseline of what to expect. If your live trading losses exceed your backtested data, then that might be a signal of a problem. So if your backtested data said that you had a maximum losing streak of 5 trades in a row, and you're just at 5 trades in a row, and then it's just about to go into your 6th or 7th, then there might be a problem, but it might mean that you're not trading properly. It might be a human error. In the same breath, if you're experiencing a large drawdown and you're finding it really tough, you can compare the data. And if you find historically that 10 maximum losing trades in a row and you're only at 6, that gives you confidence. That gives you peace of mind to stick to the plan and continue to play your edge over and over again. If you haven't watched the video on how to develop an edge as a trader, I highly recommend you go and watch this video here, because this is going to be the one video that will make you a profitable trader. I promise you. So go and check that out. Save it to later so you can watch it after this one. All right, so we know we're going to experience drawdowns, and we know they're normal, and we know if we've got a strike rate in our trading strategy of 50-50 or 70-30, we know we're going to experience some drawdowns. It's just inevitable. It's the cost of doing business. But hopefully you can see the importance of historical testing. One of the key benefits to historical testing is to lower your expectations. So one of the things that I always talk about is to make sure you focus a lot of effort and attention on finding the losers. There are some people who go into their backtesting and they see a losing trade historically in hindsight, and they discard it or discount it from their actual tested results because they're so emotionally on tilt that they can't even face putting a loser into their journal. And the reason being is backtesting takes a lot of work. And the last thing you want to do is spend 20 hours testing a pair, one market, one strategy, and find that it's not profitable over time. But I would argue that that is profitable, because if you go and trade that without knowing that, then you're going to lose a lot more money. So whatever test you do, whether you find it to be profitable or not, it's profitable, because otherwise you'll go and trade it blind and you'll lose money. Let me know in the comments if you've just traded something blind without testing it. Don't be afraid, you know, we've all been there, but let me know in the comments. All right, so I've spoken about normal drawdowns and abnormal drawdowns, and I want to talk a little bit about what to do when you go into an abnormal drawdown. But I also want to talk about forced drawdowns, right? Because forced drawdowns are drawdowns that you're going into as a result of breaking your rules, being inconsistent, revenge trading, chasing trades, because some people, they overtrade, which causes them to chase money because they they made a stupid error, and then they start going into a forced drawdown, which can't be compared to anything else, right? At that point, you need to stop trading. You need to stop trading, go and reevaluate what you're doing, calm down, go for a walk, and come back later when you're professional again. But if you do go into an abnormal drawdown, and you think, well, historically there was 10 losing trades in a row, I've taken 12 losing trades in a row. At that point, you need to review your trading, okay? And I always talk about reviewing 4 things. You want to make sure that you are in trades that you should have been in, you're not in trades that you shouldn't have been in, you're not taking excess loss on any of those trades, and finally, you're managing the trades correctly. I've done a whole video on journaling. In fact, it's an entire series, 3 or 4 videos long. Go and check that series out. That will make you a great trader. I promise you that. Your job as a trader is to approximate 0 errors and trade your plan flawlessly. This series that I put together will help you do just that. Make sure you save all these to later, guys, because this is the only channel that you'll need to become a successful, profitable trader. But remember, if you do go into an abnormal drawdown, compare it to your historic data, say, how long is this going to last? How long is this likely to last? What's my maximum loss? What's my maximum drawdown historically in terms of time and money, right? And that will keep you calm. That will keep you poised if you find that you're not meeting that just yet. And finally, on the whole backtesting thing, I want to say this. I pose this question to anyone that tells me that you don't need to backtest. Why wouldn't you? Why wouldn't you? Please, if you have the answer to that question, because everyone I've asked that to has never been able to give me an answer. If you've got the answer, put it in the comments, because the way I look at it is this. The only thing we need as traders to go forward in the markets is mental strength. Because we never know what's going to happen next. We never know what's going to happen tomorrow, right? And at any point when you're out there trading in the big bad world, you're thinking, this could be the day that it all breaks, right? And that never goes away. So the only thing we've got is mental strength. How can we be as mentally strong as possible to trade in a market where we know we don't know what's going to happen next? You have historical data to compare it to. That's all we've got. So if that's all we've got, why wouldn't you do it? Please, if you've got the answer to that question, put it in the comments. All right. I want to summarize this video and then I'm going to give you some action steps to take away right now to make you a better trader. The first one is drawdowns are a natural part of trading. You're going to have them. You're going to spend most time in them. So expect them and prepare. The second thing is backtesting is crucial to understanding what is a normal drawdown and what is an abnormal drawdown. Always differentiate between natural and self-inflicted losses. The next thing is start small. Treat yourself like a prop firm and scale up over time. That's the best way to succeed long term. And finally, a winning streak is just as dangerous as a losing streak if you're being controlled by your emotions. So the action steps for this video are review your historical data, review your trading, make sure that you're going through normal drawdowns and be able to identify natural versus self-inflicted drawdowns. Have a system for that. As I say, I've got a video. I'll put the link in the description. Go and watch that series. If you're losing more than you expected, you need to be able to pause your trading and analyze what's going wrong. I'd love to know how you manage drawdowns. Please let me know in the comments. And if you're stuck and you want more of a community, you can join my trading community, which I'll put a link for in the description as well. But that's it for this video. Don't forget to subscribe to this channel for more like this. I'm going to be talking a lot about things that other people don't talk about that are very important to your trading journey. So go and watch the other videos that I pointed out. Let me know in the comments what you want to see next, and I'll see you in the next one. Good luck in the markets.